Okay. Question for you. What areas, in your opinion, likely provide the best opportunities with the highest reward to risk? What areas on, let's say, on this cycle? We're on this cycle. The best areas are, let's go ahead and take a look at the same cycle here, but we'll look at it marked up. How about we mark it up like so? See this? This one, I marked it up. It's the same cycle showing you what's available to you to trade. So it's showing you all the strategies that are available to you as a pristine trained trader. The picture you see to the right could very well be the most important picture you ever see. Going over it won't take me more than a few minutes. Grasping it might take you 10 years, 10 months, 10 days, or even just 10 minutes. It all depends on how ready you are, where you are in your evolution as a trader or understanding as a trader. However, once you do, your trading will never be the same. That's a promise. And that's the truth. I've heard from traders that said, remember when you went over this with me 2 years ago? I thought I really understood it. And it was last week that it dawned on me that I didn't, and now I think I got it. See what I mean? I've heard from traders just like that. So stage one, what's available to you to do as a trader? What strategies? What setups? The buy setup at the bottom. So a buy setup at major support or a sell setup at major resistance. Short the bottom, buy the bottom, short the top. That's stage one. And that I don't do. It's very, very hard to do. Why? Because there's no trend underway. So you can buy at support, but support is often not just a straight line like this. It's all over the place. And there's no trend. So you can't even use the hourly chart very well because the stock is not trending. So I don't do this. You don't have to do everything that you know about or that you know, right? Every strategy that you know, you don't have to trade everything. And then we have stage two. No, before we have stage two, the stock will have transitioned, right, from stage one to stage two. So there's the transition A breakout. So again, there's stage one. Let's see, I can erase, right? Can I erase? Look at that. No, I can't. Can I erase this? Oh yeah, that's pretty nice. So there's stage one. Yeah. There's also you buy at the bottom, sell at the top. There's the transition A breakout or buy setup, depending on how the stock sets up. And then once the stock transitions into stage two, then you can do the bullish patterns long, such as the buy setup at minor support rather than at major support. The bullish pause that refreshes breakout. This breakout is not the same as the breakout at the bottom. The breakout at the bottom is called the core breakout or the position breakout, basically. This one is called the pause that refreshes because the stock is already in an uptrend, and a pause just gives it a breather, gives it a break, and it refreshes the trend, so to speak. So you can do the pullback, you can do the buy setup, you can do a 1, 2, 3 pattern, you can do a W pattern, you can do a failure pattern. Any setup applies as long as you're playing long, not short, right? And as long as the setup meets the pattern requirements. Each pattern has some requirements, and as long as the setup meets those requirements. Then transition B is when the stock goes climactic. Sometimes the stock doesn't go climactic at all. It just casually kind of tops out by going sideways and then breaks down. So sometimes the stock will do this, will go way up, climactic. Sometimes it'll just go up and then just kind of casually roll over, whichever way it sets up. If it gives you a climactic sell setup, that's called transition B. If it doesn't, then you can't really do it here. There's no way to predict. There was no way to know that this was the top. So what you look for is the breakdown. transition C. So it depends. And sometimes, as you saw on those monthly charts, you get the retest and failure, like so. Does that make sense? You get the M pattern, basically. You get the M pattern. So it depends on how the stock sets up. There's no way to know, right? And then stage 3, let's see here. How do I get rid of all of this? Okay, that was easy. Good. And then we get stage 3, which is the same as stage 1. You short the top, buy the bottom. Transition C, you do the transition breakdown, pristine breakdown. And then stage 4 is the same as stage 2, except stocks are dropping at probably 2 to 3 times the rate. Did you know that, by the way? That bullish markets take on average between 5 to 7 years. The current bullish market that we're in is the longest in the history of this country, in history. Is the longest in history. But so it's exceeding the norm. Normally, bullish markets last between 5 to 7 years. Bearish markets last between 1 to 3. That's it. 1 to 3. Probably on average, probably more on average 1.5 years. I mean, if you think about the devastating bearish market we experienced in 2008, well, started very late 2007, November, let's say 2007. Did you know we bottomed on March 9th of 2009? So it only lasted a year and 4 months maybe. So during stage 4, while it's technically speaking the same as stage 2, stocks are dropping really hard. So it's not, so it's not as easy to catch them. If you miss the entry, you're going to be left behind in the dust, so to speak. You're just going to be left behind, and the stock will drop really, really fast. So that's the characteristic of fear. And as fear turns into panic, then the stock goes climactic again, right? And those that came in late, bought the stock maybe up here, typically are the ones that exit late. Why? Does anybody know why? Think about it from a psychology point of view. Psychologically, why? The ones that come in late typically exit late also. So hoping, but why? Why is it you never let somebody get away with something, an instructor like myself, without challenging them or making sure you understand what they're saying? It's because the ones that came in late, they only came in because they couldn't stand the pain of not being in the market anymore. They just couldn't take it anymore, of missing out. So they finally said, screw it, I'm in. I'm getting in. So they needed a lot of convincing, a lot of confidence before they were willing to risk their money. And when they're wrong, they also want to be 100% sure they're wrong before they get out. Does that make sense? And those make for the worst traders possible. The worst traders are the ones that wait until they're 100% sure that that the stock is higher before getting in it, which means it's too late, right? If you only waited for the ones that you were 1,000% sure about that the stock is higher, it means it's too late. Most of the time it means it's too late, but it's always late to wait. I mean, if you wait until you're really sure that you were wrong to get out, you want to get out at the moment that you sense, that you feel you're wrong. You don't want to wait. What's the name of the game? What's the name of the business we're all in? It's called speculation. It's not called wait until you're 100% sure before you get in or get out of something. And most people miss that point. This is not a game of certainty. You don't get into or out of a position because you're 100% sure, especially when you're getting out of something. And By the way, that's exactly what leads to what creates tops, climactic tops, is the reason why the stock goes climactic like this, when they do, is because traders become incredibly convinced, 100% sure that the stock is higher. When you're convinced that the stock is higher, that this is the next Apple, the next Google, what do? You just jump in. You don't care anymore. You just get in. This is going to the moon. So when they're 100% convinced, the stock, that's when the stock actually goes climactic, right? If they're not very sure, they don't just jump in. They wait for a pullback, right? They don't chase it too much. They wait, and that's what creates this kind of a trend, right? That's what creates this kind of a trend. Because the ones that are not so sure, they always get out once the stock starts to go against them or the market. And then the stock pulls back, and then it goes back up, and then they become unsure again. They want to take their profit. They don't want to give back their money. But when they're 100% convinced that they're not going to be giving back their money because this is going to the moon, then nobody gets out, and they just buy, and then finally the stock runs out of demand. There's a limited number of buyers that are available at any given time, right? And so the stock reaches a point where there's no more sellers, no more buyers, and then it just falls apart. Yeah, when it drops, it just drops. It gets sucked into a vacuum, so to speak, and that's what creates climactic tops. All right, so good stuff. Okay, let's continue. And then again, stage 4 is similar to stage 2. It's the same idea, but except that here we would be shorting rather than playing long. Transition D is the same as transition B. Transition C is the same as transition A, but they set up differently. So again, they're in theory the same, but they set up differently. And stage 1 is the same as stage 4, right? And then the cycle repeats. The most compelling areas, the best areas that offer the highest reward to risk are the transition stages. Transition A, B, depending on how it sets up, sometimes there is no B, it's just C. So the transitional phases are the areas that offer the highest reward to risk the chart will ever see, right? Because remember, I asked you in the previous on the previous slide, what areas likely provide the best opportunities with the highest reward to risk. So that's the answer, okay?